Today we are at 40, which means stocks are expensive and a lot of the growth has already been discounted. You cannot juice an apple indefinitely. At some point the juice stops. You can apply the same logic to the stock market. You cannot keep enjoying the growth as investors now and also in the future. You have to basically choose whether you want to enjoy the growth now or in the future. I don't think we're in a full-blown mania yet. I think if we do get a couple more rate cuts, we have a significant run-up. That would likely turn this thing into a massive bubble or a mania, and that would probably bolster animal spirits, and then we will have the inevitable bust on the other side.
Markets, business, technology, investing, insights. AlphaTarget Pulse.
Welcome to the inaugural episode of AlphaTarget Pulse. I'm your host, Puru, founder of AlphaTarget and previously founder and portfolio manager at money management firms in Hong Kong. AlphaTarget Pulse is the premier research firm which invests in and publishes institutional-grade research on disruptive, high-growth companies in the public markets. Every other Friday, AlphaTarget Pulse will cover the key developments in markets, business, technology and investing, and our team will dissect what this all means and share timely insights with investors. It's now time to bring in our team of highly experienced analysts who previously worked at leading financial institutions. I'd like to introduce you to Damia, who is our quantitative analyst, the data queen at AlphaTarget, Ernest, who is the CFA charter holder and our numbers man, Anirban, a PhD in computer science and is the bleeding edge, and Oyvind, our thematic research specialist, our big picture guy. Together, this team brings diverse perspectives to every topic that we will cover on this show. Starting with you, Damia, why don't you please introduce yourself and tell our viewers why they should listen to you?
Thank you, Puru. I began my career in banking with Citibank Malaysia before moving into investments, where I spent 7 years as a sell-side equity analyst with various brokers and investment banks. Prior to joining AlphaTarget, I was vice president in research at Affin Hwang Investment Bank. Very excited to be here today. Moving on to Ernest.
Thank you, Damia. I'm a CFA charter holder and electrical engineer. Initially worked as a sell-side analyst for Societe Generale in South Africa, covering the TMT sector. Then I went on to form my own boutique research firm for 22 years, focusing on the technology sector and providing research to South Africa's largest fund managers. I was rated South Africa's top sell-side analyst for 2 years in a row in the computing and electronics sector, and I have consistently been rated in the top 5 in my sector for 18 years. I'm delighted to be here and looking very forward to adding value to all of you. Over to Anirban.
Thanks, Ernest. As Puru mentioned, I am a computer scientist by training. I did my master's on web caching systems way back in 1999, and my PhD dissertation was on video streaming protocols in 2003. This is well before YouTube was a thing and Netflix was a big deal. Then I worked in academia and in research labs where I applied AI to various networking problems way back in the mid-2000s. I have been a co-author on 70 peer-reviewed research papers from my time at academia and tech incubators. And the interesting thing is that this sort of immersion into the bleeding edge of innovation became an invaluable tool when I transitioned to full-time investing as a professional. Prior to AlphaTarget, I've held various roles, including being Director of Research and Portfolio Manager at the Motley Fool Australia. Over to Oyvind.
Thanks. So on me, I worked 5 years on the sell side at the firms Peel Hunt and Berenberg, where I was tech and thematic analyst. I've also been head of research at a VC, and most recently I was an investor at a family office.
So with the introductions now out of the way, let's move on to the key recent developments in the world of business, technology and investing. The second half of September has been a very interesting time in the markets, and we've had a number of key developments and news announcements. First and foremost, on the monetary policy front, the Fed cut the Fed funds rate at its recent FOMC meeting by a slim majority, penciled in 2 more rate cuts this year. This has positive ramifications for the equity markets, which we will cover later in the show. Next one was when OpenAI and Oracle shocked the investing world by announcing a $300 billion agreement whereby starting 2027, OpenAI will purchase massive compute from Oracle over 5 years and spend $60 billion a year. And at the end of September, interestingly, NVIDIA announced a strategic partnership with OpenAI to develop or deploy at least 10 gigawatts of NVIDIA systems for AI data centers, starting with the first phase of 2026 to power the training and operation of next generation AI models. As part of this deal, NVIDIA has announced that it intends to invest up to $100 billion on OpenAI progressively as each gigawatt is deployed, supporting the massive infrastructure build out for superintelligence. And lastly, on the 25th of September, Google CEO Sundar Pichai announced the new Gemini Robotics 1.5 model, which enhanced robotics' ability to reason, plan ahead, use tools like search, and transfer learning across different robot types, as demonstrated in a video of a robot sorting industry. So there's a lot going on in the business world, especially when it relates to AI, autonomous driving, robotics, and stuff like that. Clearly, from hundreds of billions of dollars of investments in building AI infrastructure, advancements in autonomous driving and robotics. And in today's episode, we will discuss the AI revolution and parallels we are seeing in the market today with the internet boom. So let's kick off today's show by first going to Mr. Bleeding Edge for his current take on AI. So Anirban, AI is all the rage. Everybody now, is talking about AI. Why don't you tell our viewers and our listeners, what is your view on AI? Is it a useful technology or is it hype? What potential use cases do you see for this technology?
Thanks, Puru. That's a fantastic question. Look, without doubt, AI is definitely a very useful technology. And the thing is that it has been so for years. Like if you just go back to the early days, even of the iPhone, the character selection of the keypad on the iPhone screen, that's driven by AI. Or if you think about, the telcos optimizing traffic that's flowing through their network, that was driven by AI. Now, obviously, AI is a rage and has gone viral effectively after ChatGPT and sort of, the large language models coming to the fore. And large language models are basically blending natural language processing with smart information retrieval. And that's sort of what has pushed it to the forefront of, people's imaginations. Now, beyond chatbots, I think the most important use case and, most, prevalent use case is coding assistants. Like if you think of things like GitHub Copilot, they're transforming software development. But the way I like to think about AI is that AI is a technology that sort of impacts every business and it impacts every domain. It's much like the internet. It is going to be there. It's pervasive. It's omnipresent. So I think over time, consumers and businesses have no choice but to adopt AI. AI is going to, result in significant efficiency gains and, there's going to be new business models that are going to come about.
So what do you think, and why don't you tell our viewers what is pre-training, post-training, and inference? A lot of people don't still understand what these terms means. Can you please just clarify what all this means for the general viewer?
Fantastic. Most machine learning models, they need to train on data. And they build a model based on that training, and then they produce an output. So pre-training effectively is feeding a lot of data, whether it's like books or the entire internet, whatever you have, you feed it to the model. In this case, typically a neural network. It takes that model, it learns facts, and it learns patterns, right? Once it has done this, the model is pretty raw. What you want to do is you want to get to a phase where you fine-tune this model. So it's often called post-training, where often using human feedback, you want to make sure that, the right answers are being given. Once sort of this stage is, and you see that happen even continually in the sense of when you post a question to ChatGPT, you might often get, say, 2 answers and you might be asked, okay, did you like answer A or answer B? That's sort of being used to sort of fine tune the model. Inference is really us asking questions. We ask a question, we get an answer. That's the inference step, right? So queries being answered on the trained model is effectively inference. And the way I like to think about this is in terms of if you think about intensity, training is highly compute intensive. It's typically run only ever so often when you want to update your model. Inference, is not that compute intensive. It's run every time a question or a query is put forward. Obviously, if a lot of queries go through, then the demand for inference just goes up or explodes. But individually, training is more expensive than inference. In terms of finance, I guess, or if you want to put a financial hat to it, training, I would say, is more like R&D, and inference is what sort of you would try to monetize, whether it's through advertisements or directly through a subscription or whatever. But yeah, inference is what you're trying to monetize, whereas training is the tool that lets you the monetization.
Yeah, I mean, that will make sense. So what is your view on neoclouds? We've seen recently companies come on the public markets, which are specialist data center, companies which are specifically designed for AI workloads. What is your view on the neoclouds? Do you think they're any better than hyperscalers in handling AI workload?
Yeah, so neoclouds are, GPU-heavy AI infrastructure, right? And they're designed for handling AI. They're specifically very good at handling AI training and batch processing. And as sort of the GPUs that they have become older, then they use sort of the older ones now increasingly for inference. Of course, many of these neoclouds are backed by NVIDIA, and they're quite cost effective for these sort of AI workloads. Now, the main question, I guess, and the question that we don't have, I guess I don't have an answer at least, is how long will the neocloud retain this edge? That's an open question. The AI, if you think about the hyperscalers, for example, whether it's like AWS or GCP, all of them have their own AI accelerators. So GCP, for example, has got, when I say GCP, I mean Google Cloud. They've got the TPUs, and if you want to have an ecosystem of solutions, you want a database, you want, storage, you want some sort of security solutions. If you want a ecosystem of solutions, you probably have to still go to the hyperscalers, right? So I guess, right now, both of them can coexist, and how this industry shakes out over time, again, that's an open question.
No, that's fair. Well, thank you very much for answering these questions and providing these insights, Anirban. Now I'm going to move over to Ernest and get his take on a few things which have been on investors' minds. Ernest, so what do you make of the data center Capex boom? There's a lot of spending going on by the mega tech companies, hundreds of billions of dollars. The tech giants are currently investing in the AI infrastructure build-out. Do you think this is necessary? Do you think this is sustainable, or do you think this is a waste of money which is going to come back to haunt them? What is your take?
Thanks, Puru. Short answer, justified and necessary. And the main reason is because of the massive wave of inference that's coming in the coming years. Anirban touched on that. I don't think it's a big problem, all this Capex, for the big hyperscalers. I mean, if you look at the top 3 hyperscalers plus Meta, and you add up all their Capex, currently they're spending about $300 billion. But if you look at their operating cash flows, it's about $500 billion. So they're not being stretched at the moment, and I don't think they're being overly irresponsible at all. I think what will happen is this Capex will continue for the next few years, but the growth in the Capex will slow.
Right. And recently, OpenAI and Oracle dropped a $300 billion bomb on the market, which triggered a massive rally in Oracle stock. The stock has given back a lot of those gains in the recent days. At the end of September, NVIDIA announced it is investing $100 billion in OpenAI. Some people have claimed that these arrangements amount to financial engineering. They create round-tripping circular revenues. How do you see these?
Yeah, thanks. I mean, that's very important, and there's so many comments about this round-tripping financial engineering, but I don't think it's round-tripping to prop up revenues at all. In fact, I think these are strategic deals that are going to lay the foundation of the AI environment that we're entering. And if you look at recently, Jensen Huang was interviewed by Brad Gerstner, and he said that OpenAI is a strategic investment for him, and he believes that they are going to become $1 trillion company. So he wanted to invest in them. it's not to just artificially prop up revenues. I think this is a real investment.
No, fair enough. I mean, what's your bull case and what did you think is the bear case when it comes to neoclouds, which are currently taking on debt and burning cash? So there's a lot of spend going on. Companies have come to market and they're basically investing, borrowing a lot of money and hoping that this will one day become profitable. How do you see it playing out?
Yeah, look, I mean, the bull case is quite straightforward. The clients that they serving generate profits from all these investments. So the contracts are honored. The banks get their returns because the banks are financing a lot of this Capex. And the neoclouds make their profit. Everyone's happy. The bear case is that money that everybody's spending on Capex doesn't generate the return that they were hoping. And so you start to see a few contracts getting cancelled. The chips that are in those data centers arguably worth a lot less as they become obsolete fairly quickly. And then the banks come knocking on the doors asking for money. So that's the bear case. I think what will happen is we'll get a bit of both. But I'm certainly leaning more towards the bull side of things.
All right. Well, thank you, Ernest, for your insights. I'm now going to move over to Damia and ask her a few questions about the actual numbers which have been thrown around these days. So, Damia, can you please share how much money Amazon, Meta, Google, and Microsoft have each spent on Capex in 2023, 2024, and in the first half of this year? And how much have they spent collectively in those years? And what is the outlook for the current year?
Sure, definitely, Puru. I've looked into this and got some numbers which I like to share. Amazon spent $53 billion and $83 billion in Capex for 2023 and 2024, and have spent $57 billion as of H1 of 2025. Meta has spent $27 billion and $37 billion in the past 2 years, and have spent $30 billion in H1. Google did $32 billion in 2023, then increased to $53 billion in 2024. As of the 6 months this year, Google has spent around $40 billion. Microsoft has a June fiscal year end, but looking at its Capex spend based on calendar year 2023 and 2024, it was $36 billion and $55 billion respectively. As of H1 of 2025, Microsoft has spent $34 billion in Capex to accelerate its Azure cloud business. Collectively, they spent a total Capex of $148 billion in 2023, $227 billion in 2024, and $160 billion in the first half of this year. In terms of outlook for 2025, Amazon and Google guided for $119 billion and $85 billion in Capex. Meta gave a range of $66 to $72 billion, while Microsoft guided their Capex in Q1 FY 2026 to be $30 billion, which would have brought its total Capex spend to $64 billion for the 9 months of 2025. This will bring the total projected Capex spend to over $300 billion in 2025 for all of these 4 companies.
So yeah, these numbers clearly suggest that the spending is just accelerating from $148 billion in 2023 to $227 billion last year, and $160 billion so far, and a guidance of over $300 billion this year. So with all this cash being spent on building out this infrastructure, what has the collective operating cash flow of these companies been? And we can figure out then what percentage of the operating cash flows these companies have been investing in the infrastructure build out to try and see whether it is sustainable or not.
Right. So the total operating cash flows were $361 billion in 2023, $460 billion in 2024, and $243 billion in the first half of 2025. The hyperscalers plus Meta Capex spent over operating cash flows were 41% in 2023, 49% in 2024, and then jumped to around 66% in H1 of 2025. We can see that these companies have been ramping up their Capex spending over their operating cash flow every year for AI infrastructure build out, Puru.
So yeah, we can see that although the spend is heavy, as a percentage of operating cash flow, the spend is still pretty manageable, which means that these companies are not taking on debt and they're basically funding the spend from the cash which is being generated by their legacy businesses, their core businesses, which is quite a healthy sign. Finally, Dami, I'd like to ask you, what are these, with these operating metrics and financials to keep track? Are you keeping an eye on any of these metrics to keep track of the AI Capex cycle?
Yes, I would track how much cash these companies are spending, starting with their Capex guidance. And then I would focus on return on invested capital. And more importantly, the incremental change in the ROIC. The crucial question is, how much return are they getting on the capital that they deploy? That's not easy to calculate as all of these investments have yet to be monetized, but it's the most informative metric. On the other hand, the three hyperscalers and Meta, they can easily absorb this Capex within their existing businesses. They generate huge free cash flow from their core operations, so they have the runway and flexibility to scale or dial back their spending as demand changes. Right now, they're in an AI arms race, so they're spending aggressively because they are petrified of missing out on AI.
Well, thanks, Damien. Let's move on to Oivind, and I'd like to ask him, ChatGPT went viral in late 2022, so we are roughly coming up to the 3-year mark into this new technological revolution. If we look at the internet, Oivind, or mobile or cloud, and how they've grown for 10, 15, 20 years, and the cloud market is still growing rapidly, can you give us some context, or where do you think we are in this cycle?
Yeah, sure. So I think we're still very early, especially if you look at it through the lens of productivity. So if we look back at when other big waves of technological progress happened, it took decades before you saw them having a noticeable impact on productivity in the broader economy. So if we look at the steam engine, for example, it took around 60 years before we saw noticeable productivity improvements. Electricity was around 30 years, and the internet and PC were approximately 15 years. And this is because it takes time for businesses and workers to adapt to new technologies. So if we follow that trend, where the time shrinks by roughly half, we're probably looking at somewhere around 2029, 2030 before we start seeing broader productivity gains in the economy. So still very early.
And if we are only 3 years in the cycle and the internet is still growing, after 25 years, how much do you think AI workloads will likely increase over the next 5 to 10 years? Jensen Huang recently said in an interview that inference workloads will grow 1 billion x. Do you think this is wishful thinking, realistic, or what sort of time frame do you think this plays out over?
So I think it's hard to know with any degree of precision, and Jensen is obviously talking his own book, but I think what he's suggesting isn't crazy when you look at what's currently happening. So for instance, the amount of tokens Google processed went up 50x in just 1 year. We're also seeing agent workloads requiring up to 1,000 times more tokens than basic Q&A chatbots. And we're still extremely early in companies deploying agents. Additionally, we're also going to have real-world AI with self-driving cars and eventually humanoid robots. And we're also just going to keep seeing more and more use cases as time goes by. So given the current trajectory, I don't think what Jensen is saying is crazy when we look at all the multipliers and how they will compound. And so I do think the billion X growth in workloads could happen, but potentially within 5 to 10 years. But this assumes that the tech keeps pace with demand and that we don't become energy constrained.
Well, thanks, Oivind, for giving some clarity.
If I can quickly jump in, Puru, and ask you a question here. Given what we've discussed today and what where do you think we are in the AI cycle, and what does this mean for the stock market?
Well, I think we are very early in the cycle as far as the proliferation of the technology is concerned and the use case is concerned. In my view, AI is a game changer. It will not be a linear trajectory, however. If you look at the internet, which began 30 years ago, and the use cases are still growing, and cloud computing has been growing for 15 plus years, and the hyperscalers are still growing by 20 to 30% a year at a massive scale. The iPhone was launched 18 years ago, and over the last 10 plus years, the smartphone, mobile phone market has seen exponential growth. So we are only 3 years post GPT's launch, so it is still very early days. And I think the inference workloads will grow exponentially over the next 10 to 15 years. However, if you look at history over the past 25 years, the business cycle, I don't think is going to be, very smooth. I mean, in the last 25 years, we've had 3 recessions in the US, and each time the US stock market declined sharply. Whilst the various technological advances continued, as investors, we must separate AI, the technology, and the stock market and the related investments. I think the technology will keep proliferating and growing for a long time to come. But I don't think the AI stocks are going to keep growing in a straight line. I think there is going to be a slowdown. There is going to be an air pocket at some point, maybe a recession. I don't know the reason, but we will likely get a big bear market at some point. There is no doubt in my mind that there will be, problems along the way. And I don't think, these gains will continue forever because, if you look at the stock market, either you can pull back all the future gains now and enjoy them now, i.e. push up valuations to very high levels, or you basically steadily compound and enjoy the growth as investors over a long period of time. But you cannot do both. So, either the stock market will have to cool down, or we will have a big run up next year and then some sort of a serious correction in 2027. If you look at the last 25 years, when the internet basically came into existence, in the late 90s, it really kicked off. Internet stocks really took off until 2000 March, when the market peaked. And then we had 12 years of no growth and no gains for the US stock market. The S&P basically managed to break its March 2000 high in 2013, 13 years later. So I think, looking back in terms of the stock market, I have a suspicion, and this is just my view, I could be completely wrong, that we are possibly in the late 1998 time period. There are a lot of similarities, because if you look back at that period, the internet story was the prevalent story back then, that this is the new era, the internet is taking off, and stock prices basically were stagnating. And then the Fed threw petrol on the fire by doing 3 cuts in September, October, November, if memory recalls, in 1998. And then in 1999, because of this monetary policy loosening, the stock market went absolutely gangbusters. The Nasdaq went up 70 or 80%. A lot of the internet stocks went up significantly, and then the bubble popped. So if you look today, we have, the AI boom as opposed to the internet boom. The Fed has just cut rates. The Fed has signaled that perhaps there may be 2 more rate cuts this year. So it is very conceivable that if we do get 1 or 2 more rate cuts this year, that the stock market may actually go absolutely parabolic next year for the next 12 to 15, 16 months. And then we perhaps get a bust, maybe late 2026 or in the beginning of 27, if valuations really go off the charts and if we do get a big run up. So all I'm trying to say is that, this is not a one-way gravy train. The stocks don't always go up forever. We are now 13 years in a secular bull market in the US, coming up to 13 years. And for the last, 14, 15 years, the emerging markets have been in a secular bear market, which means they haven't done anything for the last 14, 15 years. They've just broken out into a new secular bull market. So all I'm saying is that, to me at least, it feels that we are in the latter phase of this US secular bull market. Maybe we run up for another year and a half or 2 years. I don't know, it's anybody's guess. But if valuations do become super frothy, and if you look at where we end up, then, I think at some point the music will stop. Just to give you an example, in 2000, when the stock market peaked, when the secular bull market in the US, the last one peaked, the Case-Shiller PE ratio was 44. Today we are at 40, which means stocks are expensive and a lot of the growth has already been discounted. You cannot juice an apple indefinitely. At some point the juice stops. You can apply the same logic to the stock market. You cannot keep enjoying the growth as investors now and also in the future. You have to basically choose whether you want to enjoy the growth now or in the future. But for now, we are fully invested. I think we are perhaps in an incipient developing bubble. I don't think we're in a full-blown mania yet. I think if we do get a couple more rate cuts, we have a significant run-up, which is looking quite likely in 2026. That would likely turn this thing into a massive bubble or a mania. and that will probably bolster animal spirits, and then we will have the inevitable bust on the other side. But for the now, for the next 12 to 14 months or so, I think the stock market will actually continue to do well because of the Fed's policy shift. We are fully invested right now, as you guys know, in disruptive high growth companies. We are following our strategy of using stage analysis to manage risk and also hedging. So for now, as long as the stocks remain in stage 2 uptrends, we will stay the course. And when there are signs of trouble and storm clouds gather on the horizon and the stage 3 top formations start forming, then we will have to basically harvest our gains and get out of harm's way. As always, we will manage our portfolio holdings with stage analysis. And yeah, I think for the next few months, things look fine, but ultimately one would have to be super careful, especially if we get a full-blown mania or a bubble, to jump off the train at the right time before everything else turns into pumpkin and mice. So I think that concludes today's show. We hope you guys found it useful. Just a quick introduction again. AlphaTarget invests in disruptive, rapidly growing companies in the public markets, and we publish deep research on our portfolio holdings and portfolio moves since the inception of our business on the 6th of June 2024. Our portfolio has significantly outperformed the S&P. We've appreciated by about 51% versus about a 24% gain or 26% gain for the S&P 500 index. We're not guaranteeing that this outperformance will continue, but all of us as a team will try our very best to ensure that it does. So thanks very much. If you would like to learn more about our services, please visit our website, which is alphatarget.com. We'll be back in a couple of weeks on Friday with the next episode of AlphaTarget Plus. So thanks for watching. Thank you everybody for joining in.
Thank you for tuning in to AlphaTarget Pulse. We publish deep research on disruptive, rapidly growing companies we invest in. Our subscribers gain exclusive access to our entire portfolio, including exact portfolio allocations, in-depth research, coverage of companies' news flow, and our earnings breakdowns, trading alerts of our portfolio moves, and our proprietary hedging indicators. You can find subscription information at alphatarget.com. We'd love to have you join us there. AlphaTarget Pulse is a production of AlphaTarget Limited, a company registered in Jersey, Channel Islands. The opinions expressed in this podcast and the information provided are for informational and educational purposes only, and are not to be construed as investment advice. You should consult with your own registered investment advisor or other qualified financial professional before making any investment decisions.